Today, we are going to talk through a practical, step-by-step framework on building your first investment portfolio. Whether you are completely new to investing or looking to clean up your current strategy, the goal today is to cut through the financial noise. We will focus entirely on actionable principles that help build sustainable long-term wealth. As highlighted on the slide, a truly sound strategy does not rely on picking winning stock or timing the market. Instead, it anchors itself on four fundamental pillars: tax wrapper, understanding where you hold your money to legally minimize taxes and maximize compound interest; global diversification, spreading out your risk across different countries, industry, and asset classes so your success isn't tied to a single company or market; disciplined investing, staying consistent, remove raw emotion from your choice, and keeping a steady hand from market ups and downs; risk allocation, matching your investment to your personal timeline and comfort level so you can sleep soundly at night. Let's continue. To build a truly resilient long-term portfolio, we need to answer four fundamental questions. This decision forms the framework of everything we will cover today. Each step builds on the last, taking us from technical setup to day-to-day execution. Here is our roadmap: a tax wrapper. First look, we at the container for your investment. Especially, we will contrast the PEA with a standard Compte-Titres. Choosing the right account structure upfront protects your gain from unnecessary taxation. Global diversification. Second, we decide what goes inside the container. We will explore why a world ETF like the MSCI would act as an ideal core holding by spreading your investment across a hundred of global companies instantly. Third, the DCI methods. We address the how and when. We will make the case for a dollar cost averaging, which means setting up an automated, programmed, month after month investment plan to remove emotion and market timing stress. For risk profile, finally, we'll tailor everything to you. A great portfolio must match your personal timeline. We will discuss how to adjust volatility bases entirely on your age and investment horizons. Now let's deep dive into our first strategy: choice. Selecting the right account wrapper. Think of this choice as picking the container for your investment. The container you choose directly detected how much of your future gains you actually keep and how much goes to taxes. In the French financial landscape, you will primarily choose between a PAA and a Compte-Titres. Let's look at how they stack up against each other across 4K areas. Tax treatment. With PAA, patient payoff, if you hold the account for at least 5 years, you can become entirely exempt from income tax. You only pay social living. On the flip side, a country gave you no tax holiday, your gains are hit every single year by the flat tax, which sits around 30%. Eligible assets. The PAI tax advantage comes with geographic strings attached. It is restricted to EU domiciled equity and equity fund. The Compte-Titres offer total freedom. You can buy global equities, bond, US domiciled ETF, and complex derivatives without restriction. Contribution cap. A PAA has strict lifetime deposit ceiling of 150,000. The county has no limit what's over on how much capital you can deposit or accumulate it. The verdict, so which do you pick? The PAA is the best street for a long-term equity focuses investors who can look away fund for 5 years to unlock a maximum tax efficiency. The counter is the best for investors who need immediate global reach, no AE product, or those who have already maxed out their 150,000 PAA limit. Once you choose your investment account, the next major question is what do you actually buy? Instead of trying to pick winning stock or guessing which sector will outperform next year, a robust long-term strategy relies on a global diversification using world ETFs specially. A single fund tracking an index like the MSCI would give you instant exposure to through 1,400 companies across 23 developed nations. Let's break down the chart on the left and look at why this works so beautifully. The geographic breakdown, as you can see on the donut chart, the portfolio is heavily anchored by the United States at 70%, follow Japan 6%, UK 4%, France 3%, and other developed markets taking up the remaining 17%. By buying this single fund, you are essentially buying a slice of the underdeveloped world economy. There are four primary reasons why this serves as the ultimate bedrock for a retail investor. Instant diversification on single transaction instantly spread your risk across different global sectors, currency, and a hundred of individual corporate giants. Low cost because these are passive index funds that simply mirror an existing list of the companies. They carry incredibly low fees, typically boasting expense ratio well below 0.30% per years. Total simplicity. You completely eliminate the stress of stock picking. You don't not need to guess which company win. You simply capture the aggregate growth of the global economy. A core holding, this isn't a speculative play. Financial advisors universally view a world ETF as a secure core foundation, allowing investors to safely add smaller satellite positions around if it's they wish. We know now where to invest and what to buy. The next major hurdle is timing. When do you pull the trigger? Most retail investors fail because they try to time the market, waiting for the perfect dip, only to miss out entirely. The antidote to this anxiety is dollar cost averaging, or DCA. This simple means committing to invest a fixed amount of money every single month, completely ignoring a short-term market condition. Let's look at the chart on the left to see exactly how this protects your wealth. The volatility graph, the blue line represents the actual market price, fluctuating with up and down over a 12-month horizon M1 to M12. The red line represents your average cost per unit using DCA. Notice how smooth and steady that red line remains. Will the market jump around? Your average purchase price stays completely anchored. This automated strategy works for four powerful reasons. Remove timing risk, you completely eliminate the guessing game. There is no right moment to find because your entry points are mathematically spread out across the entire years automatically. Smooth volatility. This is the core magic of DCA. When a market price falls, your fixed monthly budget automatically buy more units. When price rise, it's buy fewer units. Over time, this lowers your average cost per share. Build discipline by automating a monthly back transfer directly your investment account. You turn wealth building into a consistent utilities build habit. Completely remove destructing human emotion from the equation. Lower the entry barrier. You don't need a massive lump sum of cash to build an impressive portfolio. Starting with a modest, regular monthly amount is far more achievable and less stressful for beginners. Our final PR ties everything together by customizing the strategy to you, your risk profile, and your age. There is no such thing as a one-size-fits-all portfolio. A brilliant portfolio for a 25 years old could be a financial disaster for someone who is 62. The core rules here is simple. A longer term horizon allows you to absorb short-term market crash, meaning your investment mix must actively evolve as you head toward retirement. Let's look at this illustrated glide path on the left to see how a portfolio shifts across a lifetime. Younger investor 20 to 30 years. When you are early in your career, time is your ultimate superpower. As you can see, a typical allocation starts aggressively with 90% equity ETFs and only 10% bond or cash. You have decades ahead of you to comfortably ride out market downturn to maximize long-term compounding growth. The mid-career 30 to 50 years. As we move into the 30s and 40s, the dark blue equity blocks gradually step down to 80% and then 65%. We begin a slow, structured rebalancing towards safer bond and cash. This transition shields your growing nest egg from sequence of return risk which is the danger of a massive market crash hitting right before you need the money. Approaching retirement 15 to 16 years. Finally, as a retirement near, the strategy flips completely by age 60 and beyond. Equity drops to just 30% while conservative bond and cash expand to 70%. At this age, your priority transitions smoothly from aggressive growth to absolute capital preservation, keeping volatility to a bare minimums. To bring everything full circle, let's look at the four core principles to start investing with absolute confidence. Build an investment portfolio doesn't need to be overly complicated. If you walk away from today's session, remember nothing else. Anchor your future strategy onto these four actionable steps. Choose the right wrapper. Maximize your tax efficiency right from day one. Favor a PEA for your long terms. E-equity core holding to enjoy tax-free. Gain after 5 years. Use a Compte-Titres as a secondary tool if you need broader global asset flexibility. Diversify globally. Stop trying to find a needle in a haystack. Just buying the whole haystack, a broad world ETF like the MSCI World, gave you a low cost, low maintenance foundation that captures the steady growth of the global economy. Invest consistently, take your human emotion completely out of the equation. Commit to a programmed monthly DCI strategy. By automating your investing, you benefit from market dips, smooth out volatility, and build an unbreakable long-term wealth habit. Much risk to a horizon. Remember that your portfolio must be dynamic. Let your eyes detect your risk. Shift your asset, allocating gradually from aggressive growth toward conservative capital, preserving position as you retirement horizon near. By combining these four PR, you create a self-sustaining financial engine that works quickly in the background, allowing you to focus on living your life. Thank you all so much for your time today. I would now like to open the floor to take any question you might have. See you soon.